Okay, guys, I want to break down this video that was shared by the Money Guy Show as it pertains to a 401k, what it does, what it maybe doesn't do, if you will. I know we're in election season right now as we're recording this, so I'd like to do a little fact checking. You guys good with that?
Let's do it, Russ.
All right. Let's play this video and talk about point number one. So there's 4 points on here. Let's listen to point number one.
All right, we get them all the nerdy stuff. Let's talk about why we actually love 401ks. The first thing, free money. It's a big one. Free money. I mean, boop, 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 boop. There's a reason this is before even high interest debt. If you can make 50% to 100% guaranteed rate of return, don't leave that on the table. Listen to this statistic, 92% of employers with 401k plans match their employees to some degree. So almost 100% adoption across 401k plans. And yet, we already covered this, 22% of people don't get that free match. 22% of people say, hey, you know what, boss? I don't want the free money. You just keep it. If you are one of those folks, change that right now today, because you cannot do better. It's free money. Don't let another day go by that you're not taking advantage of it. Peace.
Oh my goodness. Okay. So we need to talk about this free money, because that's definitely, they're big on free money, guys, as you hear. But also one of the things I heard them say is that this free money, it has a return. Did you hear what they said? It's either between 50 to 100%. Do you guys have any idea where they're coming up with that math?
It's guaranteed. It's guaranteed.
We know that it's guaranteed. That's definitely part of it. But here's my assumption. What they're saying is that a lot of matches are either going to match 100% of what you put in, or some may only match 50% of what you put in. So that's where I'm going with. Now, I'm stand to be corrected if that's not, but I've heard so many of these videos. I'm just going to say, based upon everything I've ever listened to, the idea of 100% return comes from, if I put in $1, I get $1, that's 100% return. Is everybody on the same page with that? Everybody's saying yes. And if I put in $1 and they give me 50 cents, then that's a 50% return on my money. What's the most important resource that you have? If you really thought about this deeply, I think you'd come to the same conclusion that Joey and I did. It's time. In our newest book, What's Without Wall Street, the 3 steps to financial freedom through passive income, we talk about how are we tracking that time. Well, what is the thing that we can do to get more of that time back?
That's right. If you've ever been listening to our podcast and thought, man, it would be amazing if I could take all the things that you guys have learned over the last 10 years and just summarize them, put them in some way to easily digest them and take action, that's what this book is all about. You're not going to want to miss it. Go to wealthwithoutwallstreet.com/new book and get your copy today.
All right, so I want to go to this free money part a little bit. So if you're not watching on YouTube, you need to be, because we're going to be breaking down this in such detail that I think it's going to be so much easier for you to watch this. But they shared this resource, and they said that in front, the first thing you do is, get all your deductibles covered. They must have shared that somewhere else, but you're going to take advantage of a employer match even before paying off high interest rate debt. Now that flies in the face of a lot of people out there doing the math. And so I want to kind of look at the math and see, is this sound advice? Well, one, they're assuming that this is going to return 50 to 100%. So in the examples that we're going to give today, we're just going to assume this person is getting 100% return on their money. So if you're working at a job and you're putting in $10,000 in your 401k and they're giving you a $10,000 match, we're using that as what they're saying as a 10% or 100% return. Now, we went and looked to see, on the internet to try to figure out what is high interest rate debt. And an article by CNBC written October 15th of this year says, in fact, the average store card now charges a record 28.93% APR. That's crazy. That is a lot, right? So if you have any of those cards out there, you know what it takes to just try to pay those down. But they're saying to you guys, hey, we're earning 100% on our money. So don't take $100% dollars and try to go pay off 27 cents dollars. That you're losing money in that situation, right? Would you see where their math is? You see where they're going?
Their math. Yeah.
Okay. Well, let's do the math. Let's do a little fact checking and make sure, though, because if we're going to follow this advice, we probably better look and make sure that it truly is 100% return. Because if it's not, I might get stuck paying a huge credit card bill. So is it 100%? So as we're sitting here breaking this down, I'm just going to say, if you had a $10,000 contribution and you got a 100% match, and we did this over the next 30 years, that means that I put in, $10,000 a year for 30 years. The company put in $10,000 a year for 30 years. How much money is that total at the end of 30 years, Johnson?
$600,000.
$600,000. But I only had to put in half of that, right? So did I not get 100% return on my money? That's what they're going to say. So let's go and do the math. Because all we have to do is put this in a financial calculator, and it will basically say, if I put in $10,000 a year for 30 years, and my money in 30 years is worth $600,000, it should say 100%. What does it say, Ben? What's my return?
The annual rate is 4.16%.
Hold on a second. How's that possible? How is it that it's not 100%? Because I thought it was 100% guaranteed.
Yeah, free, guaranteed.
Guaranteed.
Well, so they have not taken into account of time value of money, right? So the way we actually calculate money over time is we're going to figure out what its annual return is, because I guarantee you that interest on that credit card, if you don't pay it, is going to compound, right? The interest is going to apply to the balance, and it's going to compound on top of you. So you better be compounding your money, otherwise it's not happening. So when I just look at what is the benefit of 100% match on a $10,000 contribution every year, it's not 100% for 30 years. It's about a 4.16% added benefit. Great. That's a bonus. Cool. And whatever you earn, positive or negative on your return over that, great, add it. But is that going to get you, do you assume that then your investments underlining is going to earn another 24% to keep up with the credit card bill? Because by the way, the credit card bill is going to go against you. So if it's 4.16 versus 27%, I didn't even use the 28.93 that the average retail car rate is at right now. I want to just show you what is the math here. So what I want to do is show a $20,000 credit card balance. And if we use just a 27% interest rate, not the 28.93 that the CNBC article said, and I pay just the minimum 1%, because that's what I have to pay at a minimum. That's what most of these cards say that I have to pay no matter what. And I want to know, because I'm going to take the $10,000 or the $833 I have a month, and I'm putting it toward my 401k because I'm getting a 100% match. So I don't have it to pay down on this credit card because that's what they told me to do. If I'm just following their advice blindly over 30 years, I'm not paying down that credit card, guys. I'm literally just paying the minimum, and the balance is going up, 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 and up. Over 30 years, I would have paid $1.3 million, and I would owe an astounding $1.75 million on a $20,000 balance. That's how crazy a 27% credit card interest rate is compounding against me. So I'm not getting this 401k compounding at 100% for me. We already showed it's only 4.16 compounded. So that's some dumb math there. So from a fact checking standpoint, I'm going to say, yeah, if you got high interest rate credit card debt, you probably want to start knocking that out, especially when you're talking about 27, 28% interest. Your 401k is not keeping up with that. So, Jonathan, is this money free in your opinion?
Obviously not. I mean, you laid out the case right there. You don't have to be a Clemson graduate or an Interstellar fan to know that you can't dismiss time whenever you're thinking about your returns. Another way that you can think about time is just the trade-off. It's your opportunity cost. There's two ways that I really think about it. You're locking up your money until you're 59 and a half. And so you're giving your opportunities, you're putting your opportunities in a jail cell. And so, what could you have done with that money? Now, how good of a decision maker are you? Are you just buying Starbucks lattes every day? Are you just spending it on that? Or could you have started a business? Could you have done any number of other things with that money? But really, whenever you're thinking about your legacy, your longevity, it also costs your kids, does it not? It costs your family. If you become an investor, you take ownership of your life, your financial destination. Well, who are you bringing along with you? You're bringing along with you the people that you love, your friends, your family, your spouse, your kids. You're bringing these people along. They're learning along with you. They're observing. They're getting opportunities. And so if you wait until you're 59 and a half to say, okay, now I'm going to take control of my money. Now I'm going to become an investor. Well, how many years did they lose out on being able to participate in that. So no, it's absolutely not free. Not on the financial side, not on the relationship side, and not on the legacy side either.
Ben, what about
Guys,
for you, man?
Man, that's so good. Like the guaranteed and free, that just drives me absolutely crazy. I don't know about how you were raised, but my parents raised me to say that nothing is free. Matter of fact, the last time I got bamboozled into quote unquote free was my supervisor in the Army said, hey, why don't you get on this free military airplane that's going to take you to this third world developing country, also called a combat zone, where you can sign papers and get free quote unquote money to stay in the Army. Well, that was at year 4. And here I am at 24 years thinking, man, that was absolutely not free. And so that has led into what I've started doing in investing. And I'm a land investor. And so I would not take the $10,000 and try to find some match. I would take that $10,000 and invest it into my land business. And what can I do with $10,000? Well, through the Land Geek infrastructure, I learned that I can take that $10,000, buy 5 parcels at $2,000 each, and invest it that way in actual assets.
Yeah. Yeah. And I've seen you do that. And I've seen, thousands of others do that. So yeah, I think that may be a better use of your $10,000. So let's go to point number 2 with these guys. They talked a little bit in point number 2 about becoming a millionaire, but I want to hear specifically from them so that we don't put words in their mouth. Let's listen to what they say for what we should do and why they love 401ks, point number 2.
Second reason that we love 401ks is because of the way these things are structured. They actually make people millionaires. We see more people become millionaires, reach 7-figure status through their employer plans than anywhere else.
Yeah, there was a study done by Ramsey Solutions and in their national study of millionaires that found 80% of millionaires invested in their company's 401k, and asked what was the first account to hit 7-figure status. It was often inside of the 401k where that happened. So the folks that are building and growing their wealth are utilizing this tool. So why on earth would you not utilize this tool? But it's not just Ramsey Solutions. It's not just their resource. We actually have internal resources that's just the same.
Yeah, we do our own internal millionaire study every year. We ask our clients, how did they get to their wealth building? And I think if you ask the public, a lot of people would think it falls into that virtuoso, meaning somebody's just so good at something. Think of all your athletes and people that can do things, actors and so forth. Entrepreneurs, everybody would think, oh, they just invented something. Yes, and there are people that reach there, or there maybe it's that big fat cat that, that's a senior executive. No, our research shows 70% of our millionaire clients attribute being a saver and an investor as how they got into 7-figure status. That's pretty incredible.
What I love about that is it's attainable to everyone. Not everyone can be a senior executive or a virtuoso or go start their business, but everybody can save and invest. And we know that 92% of employers make available 401k. So this account is there and available and ready for you. So let me talk about the third.
All right. So not everybody can be a virtuoso, guys. But if you want to achieve 7-figure status, then, you must invest in a 401k, because their survey and Dave Ramsey's survey has said so. Do you think there's anything maybe suspicious in those surveys at all?
Seems a little bit one-sided.
Well, I mean, just imagine if you went to the DNC, right, the Democratic National Convention, and you did a survey of how many people were voting Democrat on the ticket in there. Do you think the percentages might be skewed as relates to how many people in the U.S. are going to vote? As a percentage, how many people will vote one way? So I would think, other than Matt Walsh, who was, trolling them during that event, there's probably not a lot of others that would have maybe not voted Democrat, right? Or done the same thing at the RNC. Wouldn't have mattered. So when you're polling the people that you're already telling them this information, my guess is there's probably not a lot of entrepreneurs who are their clients, right? Because most entrepreneurs, one, they don't have 401ks because you don't have 401ks for yourself. And secondly, you would just be like, yeah, this is maybe not the best way. My business has helped me become a millionaire and hit millionaire status. But I think it's important. Like, if I asked you guys, how long would it take me to become a millionaire if I was saving and investing $10,000 a year? What would you have said? What would have been your guess, Ben?
Man, at that rate, 40 years? I don't know.
Jonathan, how long do you think it'd take me to become a millionaire?
I was thinking the same thing, 35, 40 years.
Okay. Well, so you guys are wrong. I went back and I put the money into the S&P 500 and I said, when would I have had to start investing if I was investing $10,000 a year in order to become a millionaire? And it would have only required me to go back to 1999. So what is that, 25 years roughly? So, I mean, you guys, you didn't have the math right. So I was able to get there quicker because I was earning money. So 25 years. So that's how long it would take me if I was investing $10,000 a year. But what if I was investing $20,000 a year? How long do you think it would take me? What, half the time?
It's got to be half the time because, like you just said, you're investing double the money because the match, the free money.
Yeah. Wrong again. All right. So I went in there and I said, if I invested $20,000 a year, when would I have that started in order to get me to that point? So it would have taken me back to 2007. Right. So now I'm going back. Like, well, why is it that's 17 years or whatever ago? Why is it that I had to go back 17 years and it did go to 12 years? Why was it not linearly growing?
Compound interest.
Well, there was issues in, like, I didn't have this linear growth, right? There was times where the market was not growing as fast. I went through a negative time. Do you guys know what happened in 2008, 2009 to the market?
Something called the Great Recession?
It went down, right? So we had, even though we've had an amazing bull run for the last, 15 years roughly, I still did not have that same sustained growth over that period of time. And the question I want to ask is becoming a millionaire really the goal? Because what, studies have done, Monte Carlo simulators have gone in and said, hey, if I had $1 million, how much of that $1 million could I take out every single year and guarantee that money would not run out? And what the study showed is that in order for me to not run out of money over a 20-year period of time, I could only take out 4%. So that's $40,000 for every $1 million I have in an account. So if you think about that, if you need $120,000 to live on, you got to account for taxes. I probably need at least $4 million roughly in order to account for the taxation and to be able to pull out, $30,000 to $40,000 a year per million. That's why so many people are not financially free, because they don't hit $3 or $4 million in their 401k. So they work forever. And Jonathan, you talked about, is the goal to work forever? Is it to enjoy life as quickly as possible? As we know, financial freedom is not defined by how much money you have in an account. It's not even defined by having all your debts paid off. It's defined when your passive income, that's money you don't have to go to work for, is greater than your monthly expenses. So if we're in a position like that, would it not be better for us to try to attain quote unquote millionaire status, or just try to attain financial freedom? I think that would be my objective. So Ben, you talked about a second ago that you were in your land business investing. So what would it take for you to obtain $1 million in, say, income if you were using your strategy of buying $2,000 parcels with your $10,000? You want to show us a study around that?
Yeah, Russ, I'd love to. I'd love to show you the strategy because it's guaranteed to work. So let's just take my example. $10,000. We buy 5 parcels at $2,000 each. I can sell each of those parcels at $6,000. So to your question, how long to get to that, millionaire status? If you'll advance the slide, and guys, again, if you're not seeing this on YouTube, this will make a lot more sense when you can see the slides we have here. But in year 1, I only have $10,000 to invest. But when I sell all those, that turns into $30,000. So if I take now what I'm going to call my matching, I reinvest that into the company in year 2. I take my initial $10,000 that I would have put in the stock market in year 2. I add that to my $30,000. So I'm actually reinvesting $40K into my land business, buying the same type of properties at $2,000 a pop. Instead of 5 this time, I get to buy 20 properties, and I haven't changed the formula. I'm still selling them at $6,000 each. That makes it. That brings me up to $120K in year 2, or the end of year 2. Russ, if you look on my little display here and see the highlighted year, what year is that?
It looks like year number 4.
Year 4. All I've done is taken my proceeds from my land business and I've reinvested it into my business, which again is all the assets that I own and control today, not in the future. What is that number at the end of year 4 that I have accumulated?
Looks like 1.2 million.
Russell, 1.2 million. Is that better or worse than $1 million?
Yeah, that's significantly better. I know this is a hypothetical example, but how many times have you been able to buy a property at 2,000 and sell it at 6,000 for the person listening who doesn't know the answer to that?
I am no Mark Podolsky at the least, but man, at least dozens of times. I've done hundreds of deals in my 3 years in my land business, and I can tell you these are out there. This is not some mythical unicorn that we're trying to capture. These are real deals that you can do.
There was nothing worse than walking into class when you're in school and the teacher saying, "Pop quiz day." Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
So there's a lot of different ways that you can try to grow income or grow wealth. Jonathan, for you, if you had $10,000, what would you have done with it? Well, Ben was using it in his land business. What would you have done?
Well, in the short-term rental business, which I'm in, there's a couple of different ways you can go about it. You can purchase the real estate, but you can also do an arbitrage where you rent from a long-term landlord and you pay the long-term rental rate, and then you keep the profit as you rent to short-term tenants. In this example here, you can see that you're taking that annual savings amount of $10,000. In year 1, you're not going to have enough to invest potentially in a short-term rental arbitrage. You're going to need to buy furnishings for that. And this example, again, is a hypothetical example. It's based on you running the business yourself, not having an operator, you being the operator. But it is a conservative example. This is something that's certainly possible out there. So you get to year 2, whenever you get to year 2, now you've got enough. You're going to buy the furnishings. You're going to go under contract with that landlord, and you're going to invest a portion of what you've saved, that $15,000. And you can see how it stacks. Year 1, you can't fully furnish a unit, but year 2, you can get 1. And then in year 3, you can take the proceeds. Again, this is a compounding example. You take the proceeds that you've earned plus what you've already planned to save, and now you can add 2 more. Well, then momentum starts to pick up a little bit. Now you add 5. Now you add 8. Now you add 13. And then on down the line, let's cross that $1 million mark. When we cross the $1 million mark, it looks like year 9. And this is annual returns as cash flow.
Oh, wow.
Cash that comes to your pocket. Now, in an arbitrage model, you don't get all the great benefits of owning real estate, but the benefit that you do get is a big one, and that is cash in your pocket.
Yeah. And by the way, have you ever done any short-term rentals?
I've done a few. Yes, sir.
And for us, Joey and I, as you know, we did this short-term rental arbitrage. We actually got 25 units up and running, and in less than 18 months, we were, averaging somewhere between $25,000 to $30,000 a month of income. And ultimately, we sold that business for pretty decent mid-6-figure number, and in about 3 years. So when you say it take you 8 to 9 years to get to $1 million, I totally see the math, because that's the rate that we were running on had we continued down that path. All right, so let's go to point number 3 that they had is, what other ways do they love 401ks? And let's see if their strategy is the best strategy to follow. So let's jump into their video right now.
Third reason why we love 401k plans. They are one of the best ways to legally hide money from the government. Nobody likes paying taxes. Well, one of the great things that 401ks let you do is they let you legally avoid paying taxes. Now, you get to choose. Do I want to avoid paying taxes today and do pre-tax contributions and let my money grow tax deferred, or do I want to avoid paying taxes in the future? I can do Roth contributions today, my money grow tax deferred, and then when I take qualified withdrawals, it'll be completely tax-free. 401ks are one of the absolute best mechanisms to lower your tax bill either now or in the future, so you should certainly take advantage of that. Number 4.
Oh, wow. This is what we talked about when it talks about the ability to legally reduce your taxes, the best way to reduce your taxes today or in the future, as they say. I take some issue with that, and I want you to go through this example with me. One, they said this is the legal way to hide money. Do you guys believe that you can hide money in 401ks and IRAs.
Absolutely.
Yeah. Well, I went on the internets, and I asked AI, how much money are in qualified retirement plans? That includes all 401ks, 403bs, 457 plans, thrift saving plans for those like you, Ben, who was in the military. And you know what it told me? As of June of 2024, Americans had $40 trillion in retirement assets. Well, how hidden is it if AI knows there's $40 trillion in there? So who's it hidden from? I think it's just hidden from you, the investor, because you don't get to touch it. Because the government knows how much money's in there. I guarantee the investment advisors who are getting paid fees off of all of this know exactly how much is in there. So who's it hidden from again? This is the most silly thing. I just love it when people make just not very smart comments like that, because 401ks, IRAs, qualified plans, they do two things. They defer the tax. You're not getting rid of the tax. You're deferring the tax, or you're also deferring the tax calculation. Well, why is that important? Well, as I pulled up the U.S. debt clock, and I see today that we have over $35 trillion, approaching $36 trillion in our U.S. national debt. Do you believe the government's going to need less money in the future, Jonathan, than they do today, based upon the growing trend of how much debt we have and how much we have to pay to service that debt?
More and more taxes coming to your door, to a mailbox.
Because, Ben, the only way they create income is not by going out and building businesses. It is by taxing businesses, correct? And individuals. Okay. And by the way, if you're not paying your fair share, as we like to hear from our rhetoric today in the election season, that means we're going to have to pay more. So if we're trying to defer the tax to a future date, do you think the tax rate's really going to be less? No. The answer is no. But then the other side of the argument that they gave is, you should just do a Roth 401k. That makes so much more sense. Well, I had this discussion one time with actually my CPA and his 10 CPAs that work with them. And I asked them the question of, if I invested the same amount of money in a Roth, or, after paying the tax today, or I put it in a 401k and they both earn the same rate of return, both were taxed at the same rate today or in the future, which one would come out ahead? And they all gave me different answers. And all those answers were wrong. And I'm going to show you why. So let's take the $10,000 contribution example, and let's just pretend I'm going to earn 8%. I am not speculating that that's actually a rate of return, but let's just say 8% was rate of return and I was at a 25% tax rate. That means that in 30 years, my account would be worth $1.2 million. And if I paid 25% on that money at that point in time, I would have $917,000. That's how much I have, right? So let's compare if I would have done a Roth contribution. So instead of having $10,000 because I had to pay the 25%, I have $7,500, right, Jonathan? And if I invest that at 8% over 30 years at a 25% tax rate, what amount of money do I have, Ben, at the end of 30 years in my Roth account?
I was shocked to learn this, but it's the exact same $917,000.
Well, it's math, right? It literally is math. Math is so fun, is that you can't trick math. Math is math. So why is it that they both have the same amount of money in them? It's because I'm doing the exact same thing. So I'm not compounding interest on the government's money, all that garbage that gets talked about with qualified plans. So what happens if tax rates change? Tax rates are the only thing that will impact which one will have more or less money in it, true? So if tax rates are changing as time is going on, if I end up in a higher tax rate in the future, which one will be better for me, Jonathan? The 401k if I'm in a higher tax rate, or the Roth if I'm in a higher tax rate in the future?
Looks like it'd be the same.
Well, the Roth would end up being better. I didn't clarify that very well. If rates grow as time goes on, right, and I've been putting money in a 401k at 25%, but I have to take it out in a 30% tax bracket, but yet if I was able to put it in a Roth, right, at 25%, and I don't have to pay tax in the future, that would have been the better option. But if tax rates do go down, right, if I am the ultimate optimist in this deal, and I put it in a Roth, I'd be pissed because I paid tax at 25% and I was able to take it out at, the tax rates are only 20%. And I'm like, oh man, why did I do that? I would be stupid. So here's the key, though, is that nobody knows what tax rates are going to be. Only one group of people get to decide it, and it's not you. So why in the world would we be taking advice from people that are telling us which one of these are going to help us save tax? Because they are not saving tax. They're deferring the tax or are paying it now. And I don't know if it's going to be good or bad for me. I have to decide that in the future. I think that this is a silly decision being made by financial professionals who get paid to manage money. And I understand why they say what they say, but the facts are the facts, and that's just not good advice. All right, so let's go to their next point so we can try to hear what is the fourth reason that they love 401ks.
Because I think I said legally way too much, just like you did. But it creates automatic, always be buying opportunities. Here's the thing I need people to understand that why I love 401ks is because if you can understand, let's make the good habits as easy as possible and make the bad habits super hard. How you fix that is through automatic behaviors, is because it doesn't matter what's going on in the stock market. It doesn't matter what's going on in the economic or political world. If you're always buying, it creates an inevitable path towards your future success. It's incredible. It's an awesome thing.
It allows that to happen even when you don't think it's possible, even when you think the sky is falling. You don't believe us? Look at this illustration. We said, all right, let's look at the S&P 500. From October of 2007 all the way out till October of 2013, right? So nearly a 5.5 year period that we're looking at. Well, the S&P started that period about 1565, and it closed that period about 1563. So you would argue this was a flat market over a 5.5 year period.
And the visual shows that. That's one of the things I know there's a lot of podcast listeners too. I had a listener who put a comment and said, please, I've come on YouTube to give you this comment. Remember, a lot of us just listen to the podcast. So visually, this looks like you invested for 6 years. I mean, you look at the chart, you're like, why would anybody invest? The chart went down, and then it's completely flat for 6 years. However, Bo is about to flip the switch on the chart. You're going to say, wait a minute, that chart is the exact same period. It starts in October 27, 2007, goes all the way to October 2012. Why do I not see that down to sideways part of the chart? Bo, explain the rest of the picture.
So what if you or this person, this market, you said, I'm just going to put $500 every month in my 401k account. I'm just going to do that. Well, if you behaved that way, over that 5.5 year period, you will have saved $33,000. But that $33,000 will have grown because you are always buying to $46,327. That is a return of 11.9% annualized, almost a 12% rate of return in a 5.5 year period where the market was flat. So if you can make your behavior automatic and always be buying, more often than not, the market is going up and your contributions are going to be working for you. If you can set it up that way, Brian says all the time, you are on your path to inevitable wealth.
Man, you're on your path to inevitable wealth, guys. So what's your thoughts as we break down this final point of always be buying? Are you agreeing with this strategy or disagreeing with it?
Russ, I totally agree. Always be buying, but I totally disagree with their mechanism for it. This is, guys, you said earlier, Russ, do the math. This is not great math. Using my example again, I would not have bought stocks. I would not have even tried that flat rate. If you'll see this on their video, but that graph is not beautiful. In my example, year 4, my business had generated an income of $1.2 million. So they describe in their video that over that 5-year period, and they specifically shows that 5-year period for whatever reason, I don't know, but they showed an 11.9% annualized return. I guess that sounds okay, but let's look at what my land business would have done in that 5-year period. That I'm just, again, all that's coming out of my pocket is $10,000, and the business is putting the money back into itself. My annualized return, my annual return is not 11.9%. It's 200%. All you need is a financial calculator to do that math. And you see it right here on my slide. Again, hypothetical, but so is the stock market. Nobody has a crystal ball, Russ.
Yeah, I mean, obviously, in this example, what you're doing is taking $10,000 and you're buying those parcels of land at $2,000 and flipping them at $6,000. And you've done this, dozens and dozens and dozens of times. And we know people have done this. I don't know, like our friend Mark has done it over, it's thousands times. I think he says over 6,000 transactions. And so these aren't fabricated ideas. They actually happen. Now, they cost money to run the business and all that stuff. We have to put that in here, but just keep math simple because they're not taking into account what it costs to run that business. It is interesting that there are ways to make money. And if you look at what everybody says, just put it in the market. Just trust the market. But what happens when the market lets you down? Can you truly continue to trust it? Ben, do you have the ability to impact your land business personally in any shape or form?
Absolutely.
Yeah. Because you get to figure, you can work harder, right? You can make different offers. You can change your offer. You can hire virtual assistants, right? You can do more marketing. You have the ability to impact your business. Jonathan, do you believe in this always be buying concept?
Yeah, let's give these guys some grace a little bit. We've got some common ground, right? We believe that we ought to save. We believe that we ought to invest, and we believe that you always ought to be buying. But save where? Invest in what? Always be buying what? Those are big distinctions as well. Right. If you're buying rental properties, long-term rental properties during this time period, guess what would have happened when the market goes down? You remember how home prices just tanked during that time. A lot of people lost their real estate because they didn't fix their debt. There's wisdom to be learned in there. But guess what? The market's on sale. You're taking the same dollars and you're buying more house with it during this time. And during that time frame that they talk about, rental rates across the nation went up. So you get more whenever you buy. Your rental rates, your cash returns go up. If you have reserves that you have access to, you can take reserves out of IBC to protect that downside. If you didn't have all your money tied up in your 401k in the stock market, which had just been cut in half, you've got reserves in the right place where you have access to not only invest, but also for emergencies to protect yourself. And this is a great way to protect yourself when people were losing their jobs and people were losing their houses because of debt that's not fixed, because of income that's gone down. You've also got the ability to, if you've saved in the right place, you've got the ability to get through those hard times because you can tap that equity in your homes. You can tap that equity in your IBC policy. You've got to store your wealth in a place where you can access it for the needs that you have to grow and also for emergencies.
Well, I know. See, I was a certified financial planner during these days. So I know exactly what people were thinking who were invested in the market because I was talking to them, right? They were my clients. And I was trying to convince them to always be buying, baby. Like, don't take the money out. But see, here's the thing. There's a really interesting thing about human behavior, right? While you can look at these charts and say, oh, if they would only been buying and kept buying, this is what would have happened. But human behavior does not stay consistent in times of stress. In times of stress, people do different things, right? So what I experienced is when the market was crashing, people wanted to put less money in the market. They didn't want to put more money. They would put less money in the market because they were fearful, right? Why would I put $1 in here and have it go down to 40 cents? That doesn't make any sense, right? Why would I do that? What else were they doing? They were being laid off their jobs, as you said, Jonathan. So then they were actually going into their accounts and taking money out of the accounts, right? This is actually a time frame where a lot of employers had this ability for employees to be able to access money in the those accounts. That changed after this, right? Because people were taking so much money out that these advisors did not want them to do that they literally changed the contracts. They quit the in-service withdrawal options. So people were not consistently buying. What they were doing was stopping. They were taking money out. And to say, oh, well, they would just keep buying. Well, yeah, that's in theory good to say. Unless after the fact, look at the numbers and say, oh, that would have been good for you. But people do not do that. But yet, if you own your own business, right? Like the two of you guys, you own your own business and you're able to see and impact the results, which I couldn't do in the investment world, then I could determine, yeah. And so I actually had two clients that were home builders. And if you guys remember, there was not a lot of homes being purchased, much less being built. Mm-hmm. But these two guys recognized that there was a humongous opportunity. As developers and home builders were going out of business left and right, they went out and raised a ton of money, millions and millions of dollars. And what they did is they went and bought every single lot from all these defunct development projects that were out there. And they held on to them for 3 years. And then about this 2012 timeline, into the timeline they were sharing, you know what happened? People started building and buying homes again. And so they started building homes. They started building homes to the tune of 100 to 200 a year. And other home builders couldn't build a whole lot because they didn't have lots. These guys had all the lots. And you know what ended up happening in about 3 years? They sold that business for like $25 or $30 million. It was an amazing opportunity for them, but because they were business owners, they understood how to impact the return. Unlike the investment world, they couldn't. But there's another thing that the investment world forgets to tell you, and this is this concept of sequence of return risk. If you've never heard this term, go Google it. It talks about what the risk is to us when we start taking money out of the market. And if we're taking money out of the market during times where the market's going down, we actually, that chart I showed you a second ago of, hey, how much can you take out and not go to zero? Well, this is what it's accounting for, is when I'm taking money out of the market, let's just say during 2008, right? Because they started their chart in 2007. I had $1 million out and I was following that 4% rule, right? I was taking 4% out of the market. At the end of 2008, instead of having $960,000 in my account is going significantly down. Why? Because I had a 37% loss. That would have significantly reduced my account balance, where I would have ended up not with $960,000 in it, but with only $604,000 in it, right? So no matter what's happening with my account, if I start taking money out of it, I end up with a significant less amount. And what happens too is that I don't get the benefit of the gain, because once it does start to come back, but yet I don't have the money in there because I've withdrawn it, that money's now gone. So sequence of return risk is a huge factor that most people do not account for when they start thinking about what's happening with the market. So are you taking money out of the market? And if you are, and the market's going down, you're going to be significantly impacted the earlier those withdrawals are being impacted by downturns. So this is just a great example. Thank you guys for jumping in here with us. For us to show that there's another side to the story, that maybe if you are working as an employee within a company, maybe you should try to figure out how to become a better investor. If you haven't figured that out, go to whatsaboutwallstreet.com/PIOS. And we actually teach you in a free ebook how to build your own passive income operating system, how you can turn active income into passive income, and how you can become a better investor, how you can take steps that keep access to your money, help you build passive income, and more importantly, build a system around it so that you can become financially free faster. Jonathan, Ben, thank you so much for joining us today. Thank you for listening. Hope you have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand, so that your wealth will never run dry. See you next episode.